Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. As I mentioned in the last episode, most New York Times articles about long-term care insurance have had a negative slant with a lot of half-truths. In the next few episodes, I'll provide the other half of the truth. But first, I want to share three important points that the New York Times omitted from their article. Any well-researched article on long-term care insurance should include these three facts. Number one, long-term care insurance policies sold before 1993 were horrible. They should have said that. Number two, newer long-term care insurance policies have different pricing rules than the older long-term care insurance policies. And three, 41 states now have affordable long-term care insurance policies specifically designed for the middle class. Now let's discuss each of these 3 points. The first one, number one, long-term care insurance policies sold before 1993 were horrible. They were. Everyone knows this. Insurers know this, regulators know this, consumer advocates know this, even most insurance agents know this. We all know that before 1993, long-term care insurance was nothing like modern long-term care insurance. Comparing a long-term care insurance policy purchased before 1993 to today's policies is like comparing a rotary phone to a smartphone. Most things have improved over the past 40 years, even long-term care insurance. The article states that older policies covered only skilled nursing care in a facility. Now that's true, but that's not even half of it. The policies were even worse for a lot of other reasons. Most of the policies sold before 1993 did not cover Alzheimer's or dementia. Most of the policies back then had ambiguous claims language and ambiguous claims triggers like medical necessity. All that was changed in 1993 when the NAIC, the National Association of Insurance Commissioners, created the long-term care insurance model regulation. This regulation required that Alzheimer's and other forms of dementia be covered. This regulation required clearly defined benefit triggers using the activities of daily living as well as clear definitions for cognitive impairments. Policies could not be canceled by the insurance company unless the premium was not paid on time. In 1996, as part of HIPAA, the 1993 long-term care insurance model regulation was added to federal law. Any policy that would include these consumer protections would receive special tax treatment from the federal government. This is called a tax qualified policy or a federally qualified policy. Tax qualified policies have tax deductible premiums, and in most cases, the benefits are 100% tax free. Why didn't the New York Times mention this in their article? Why does the article give the impression that all long-term care insurance policies are the same? Why write an article about a policy purchased before 1993 and imply that all long-term care insurance policies are like that pre-1993 policy? The article also fails to mention the two biggest improvements long-term care insurance has had since 1996: the rate stability regulation and long-term care partnership programs. Everyone knows that older long-term care insurance policies have had huge rate increases. That's not what consumers are asking today. What a consumer wants to know is, if I buy a long-term care insurance policy today, will I have the same big premium increases like the older policies had? No. The answer is no. Here's why. Here's the bad news. Any long-term care insurance policy purchased today in any state is the most expensive long-term care insurance policy ever sold by that company in that state. Here's the good news. Any long-term care insurance policy purchased today in any state is the most expensive long-term care insurance policy ever sold by that company in that state. I didn't mess up. The bad news is the good news. The good news is the bad news. The old, cheaper policies had huge rate increases. The new, more expensive policies already include all those rate increases in today's pricing. That's why the new policies cost a lot more than the older policies. Additional, 41 states have enacted even stricter regulations regarding the rate increases. It's called the Rate Stability Regulation. If a state has passed the Rate Stability Regulation, any policy purchased after that date must conform to these new, stricter rules. One of those rules has to do with the profit incentive. Under the old rules, when a rate increase was requested, the insurance company could price normal profit levels into the rate increase. But the Rate Stability Regulation changed that. If an insurance company requests a rate increase, they must decrease their profit levels to a cap that is predetermined by the regulation. Even the rate increase itself cannot include normal profits, just a small amount to cover administrative costs. The Rate Stability Regulation has removed the profit incentive from rate increases. Did the New York Times write about that? No. Not in this article. Not in any article. Over the past 18 years, not one New York Times article has ever mentioned the Rate Stability Regulation. The third omission in the 2023 New York Times article on long-term care insurance is that they failed to mention that 41 states now have affordable long-term care insurance policies specifically designed for the middle class. Now, this program started in 2005. Congress passed legislation that allowed every state to create what is called long-term care partnership programs. Some states call it long-term care insurance partnership programs. These programs are a partnership between the federal government, each state government, select insurance companies, specially trained insurance agents, and consumers who want to plan ahead to protect their assets from long-term care expenses. These programs encourage the middle class to purchase long-term care insurance because if their policy runs out of benefits, they can apply for Medicaid to pay for their care, and some of their assets, possibly all of their assets, will be protected from Medicaid. Their assets are protected from Medicaid while they are alive, and then even after they pass away, which helps protect the assets for the next generation. This kind of program should be heralded by the New York Times. A consumer can target how much long-term care insurance to purchase based upon how much of their assets they want to protect from Medicaid. To protect more assets, buy more benefits for a higher premium. To protect less assets, buy less benefits and pay a lower premium. The long-term care partnership programs are the equitable solution to our nation's elder care crisis. The wealthy pay more to protect more assets. The not so wealthy pay less and can still protect all of their assets. In all cases, a lifetime of savings can be protected through a long-term care partnership policy for those who plan ahead and purchase a policy while they are still healthy. In the next few episodes, in our in-depth analysis of the New York Times long-term care insurance article, we'll discuss what the New York Times got half right.